Hey, Dan, how's it going?
Hey, George. Doing well. Good to see
All
you.
right. So, everybody, welcome to the show. Here's the thing. I brought Dan in. We were having this really great conversation. There's a number of folks out there that are getting loans, and all of a sudden, boom, their phone and their email just start blowing up because they're getting different quotes, different lenders, all kinds of insanity. And so, really, the best thing to do is, well, let's bring in the professional. Let's bring Dan in. He's going to give you the absolutely three top best ways to keep your phone from blowing up. All right.
Yes.
Let's hear it, Dan. Let's go with number one.
Well, can I tell a little story first?
Sure.
So we had a client recently that applied for a loan, and they were really upset. I got a call the next day. We pulled their credit, and they got really mad at me because their phone was absolutely getting blown up with text messages, auto voicemails, emails. It was all AI driven. And basically what happened is credit bureaus out there, not me, wasn't me. The last thing I want is to do a loan, get a loan client to, moving, and then they get a bunch of competing offers coming at me left and right. Not that I can't be competitive, but it just becomes a problem, and it's a huge annoyance. So you can avoid this. This is avoidable. The first thing you can do is you can opt out, and there's a website on the screen there, optoutprescreen.com, and it's the credit bureau's site. It's not a third-party site. It's actually the official credit reporting industry's website to accept and process requests for consumers to opt out or opt in. And so what it does is you go through this website, and at the bottom there's a link, and it basically allows you to opt in or opt out or opt in. You can do either one. So there are benefits to staying on this. You do get competing offers, as it says, I think on the left side. What are the benefits of receiving these offers? So if you're applying for insurance or a credit card or a car loan or even a mortgage loan, if you're opted in, you're going to get other offers.
Right.
And it's going to be, but they're going to be AI driven, and you're going to get 100 of them in a day, and they're not going to stop. They're relentless, and they're very annoying. And this is, in my opinion, not worth it, but it's up to you. So if you opt out of receiving these offers, there's a 5-day delay. So if you're about to apply for a car loan or a mortgage loan or a credit card, and you haven't done this, and you want to do this tomorrow, you might want to wait 5 days. Do this today, wait 5 business days, and then go have your credit pulled.
I think that was super important, Dan, that you mentioned not calendar days, but actual physical business days. If you do it today, tomorrow is technically your first day. Is that safe to say?
That's right.
Okay. So let's say today is Monday, right? So technically the first day would be a Tuesday. And then so on the following Monday, which would be the 5th business day, anytime after that, you would be relatively safe because, like you say, their phone just absolutely blew up. And like you said, they are relentless. So, I mean, if you really wanted to get quotes on insurance or a car loan, sure. Real estate contracts, you and I both know there's a specific timeline you have to quote unquote make full application, or you lose that opportunity on your financing contingency, which is a caution for a lot of people out there. So, all right. So fair enough. So that site for everybody, and we'll put this down in the remarks below, along with Dan's information. So if you have additional questions, want to definitely reach out to Dan. He is one of our preferred vendors. I've worked with Dan for probably more years than he would like to admit, but nonetheless, we're still there.
You can opt in as well. So if you decide to opt out, and then 2 years from now you want to get back in and get those offers, you coming back here and opt back in. So you can opt in and opt out. The last 5 years.
5 years.
Yep.
5 years. Okay, cool. So again, optoutprescreen.com, all one word, optoutprescreen.com is where you want to go. Again, we'll put that in the information down below. So All right. So, Dan, I've gone out. I went to optoutprescreen.com. I watched your video. Said, oh my gosh, I do not need my phone blowing up. So now I'm coming to you and I said, hey, dude, I did this, but I just did it. Like I did it yesterday. What's the next thing I need to do?
Well, if you're looking to be pre-approved, what I would do is make sure for a mortgage, at least, I don't know if other companies, credit card and those can do this, but ask them to do a soft pull only credit report. So the trigger that in the previous number one, to opt out, is if they do what's called a hard pull credit. That's what's going to trigger all that marketing that we talked about. So what I would do is say, I do not want a hard pull credit. Make sure you tell the lender that they are not allowed to do it unless you give them permission. And it can be verbal permission, but you can say, please do not pull my credit unless it's a soft pull credit report, which is what we do for all of our customers until we know that we actually, every single client that comes and applies with me, I do a soft pull credit only. I can pre-approve them on that. I do eventually need to do a hard pull credit, but the next step I do with every client after this last client that got so upset with me is I make sure they know about the opt-out, which is the number one thing. And again, the clients got upset with me, but it wasn't me. So I had to explain that to them. This is not something that I trigger. I do not trigger this marketing. It's the credit bureaus. It's nothing to do with me whatsoever.
Yeah. So it's funny that you mentioned that, because most people, all they know is, hey, I need to pull your credit, and people, they're unaware that there's different levels of a credit pull, a soft pull, a hard pull. Just like a credit card company will do a slightly different pull than a car loan company, a lender does a deep dive. In fact, let's just sidebar really fast, just to let people know, because we get the people that say, hey, yeah, I went to Credit Karma and here's my credit score, and I smile and I'm like, well, I understand that's not going to be the same type of pull, the same kind of report that a lender gets. Those Credit Karmas, those free reports, that's at the 60,000 foot level, and lenders, they want at the 1,000-foot level. Can you chime in a little bit so people understand the difference between the two?
Yeah. So like you said, a lot of people now with their credit card companies, they offer a free credit score. And so they'll every week update your credit score, and you can look at it on your, whatever Wells Fargo app or your Chase credit card app or Capital One app. Almost every single credit card company offers that now. And those scores, while they do give you a kind of a gauge of where you stand, they are going to be completely different scores than when you pull credit with a mortgage company. And it's because we do a much more deep dive credit pull, and there's like 1,000 more factors that we look at. And so you're getting, like you said, like a kind of an overview, kind of a baseline. You're in this credit score range when you look at those credit card companies and Credit Karma. When you go to a mortgage company, you're going to probably be a little surprised. They're also going to pull three of the credit bureaus, all three credit bureaus, and we take the middle score. So the credit card you're using might pull only one of the scores, which might be your highest score. Well, we pull three, and if that's your highest score at 750, and then you have another one at 700 and one at 725, we use 725. And so I get the call like, wait a second, my score says 750. For us, it's 725. So
hey, let me sidebar that one yet again. Mm-hmm. So when we have a husband and wife, and let's say that the middle score was 725 for the husband and 800 for the wife, a lot of people think that, oh, okay, they're going to go with the 800 for the wife, and the real answer is
the lower of the low mid score. So you're going to use 725.
Right. So sometimes that's why we see a spouse not being on the loan per se, because she may not have credit, and therefore it brings everything down. So she'll be on title, but if she's a stay-at-home mom or something like that, I forgot what they call that now technically. But anyway, I call it a stay-at-home mom, where she may not have a credit score. They'll only have the husband on there, but both of them on title. So
right.
Anyway. All right. Item
You know,
number 3.
that's,
So we said there were 3 things. Yes.
yep. So number 3 is have your credit pulled annually. You do not have to go to a lender for this. You can do it yourself. And again, there's a website that you can go to, freecreditreport.com. Be a little careful when you type that in. Make sure you see this screen right here that's on the screen here. There are a lot of companies out there that will say, freecredit.com, for example. I think that comes up. That's a third party. They're going to try to get you to subscribe to a service. This is completely free once a year, and it gives you your credit score. What's nice about doing this, or what's smart about doing this, is if you can take a look at your credit report. You see anything strange because you haven't seen your credit in 9 months or 12 months. You can go, wait a second, I didn't apply for that card, or that's not my loan, or whatever it may be, or maybe your score is dramatically lower than you think it should be. Then you can start investigating. So I would do that once a year. Take a look at your credit reports. You're aware of what's on your credit and everything. If everything looks great, you're good. You just move on.
Okay. When you say you should look at that annually, do you recommend people to lock their credit?
You can do that. It's not a bad idea. You can freeze. It's called freezing your credit. You can freeze it, so that doesn't allow people to, try to utilize your social security number and, basically fraudulently use your credit. A lot of people do that. You do have to when you apply for a mortgage. I'm pretty sure on probably a car loan is the same thing. Any kind of loan you apply for, a credit card or whatnot, you're going to have to unfreeze it. So you're going to have to go in and unfreeze that credit. And I think it unfreezes it for like 48 or 72 hours. And then you allow people to pull credit, and then it auto freezes again. So that is not a bad idea.
Okay.
That's a good idea.
All right.
Not a bad thing.
With a lot of stuff that's going on with some bad actors out there, it does make sense to make sure, because there's nothing worse than finding out all of a sudden, you've applied for different loans or whatnot. It's beat down your credit score that you work so hard to keep up, and lo and behold, it's somebody who's doing an identity theft, and you get to fix the problem. So, and that's
some lenders make mistakes. There's lenders out there that they misreport, and you can get that resolved fairly easy if they're doing something by mistake, and that does happen. I've seen that. It's like, but then what the problem is, if you don't catch that early before you're trying to obtain credit, when you're trying to obtain credit, you're probably trying to do something fairly quick. You're probably trying to buy a car, get a credit card, whatever, buy a house, and you need that credit to look good for, pretty quickly. So you want to be ahead of it. That's the name of the game.
So that's super smart. If somebody was looking at getting a loan to buy a home, how far in advance would you recommend somebody being proactive, looking at their credit report, looking at what their bureau says, before they truly head down the path of, hey, I'm going to buy a house?
I'd say 2 to 3 months. An approval lasts, officially the approval lasts 120 days, but I always tell people 90 days because I have to start updating things, and you need some time to do that sometimes if you want to be reapproved out, past the 120 days. So I'd say at least 2 months, 2 to 3 months, start looking at getting pre-approved, having someone pull your credit, take a look at the credit report, make sure there's nothing we need. I can help you improve your score. That's another tangent we can go on too. There are ways to improve your score quickly with what's called a rapid rescore, and we can talk about that if you want.
Sure. I think this is super important for folks that, this is our bonus material.
Yeah.
Let's say that, you pull my credit, and, my one credit card maybe is just, it's higher than a 30% balance. And maybe I have 2, and all of a sudden I've noticed that my credit score, I'm just under that threshold of getting that better credit score, which means I get a lower rate.
Right.
You can do what for me?
So I have a tool that I can run your credit through, and it'll tell me, hey, if, we think if this balance goes down by $5,000, or even sometimes $500, sometimes it's a minuscule amount, your scores will go from 699 to 705 or 720. And all the scores are everything is based in a 20-point increment. So if you have a 680 to 699 score, you're in the same kind of rate category. You go from 700 to 719, the next category, and it goes like that until you hit 760. And if you go to a jumbo loan, it goes all the way to 800. Those incremental 20-point increments allow better pricing, better rates, and you can change those scores I can do it within a 2-week period.
Wow, that's pretty fast.
Before you buy your house, before you close on your house, or before you get pre-approved.
So what you're saying is that if somebody is interested in saving money and like thousands of dollars, it behooves them to get in, take a look at your credit report, have you run this tool, find out what it takes for them to get to that next level so that they can get a lower rate.
That's right. Yeah. There's ways to do that quickly.
That seems pretty logical. It seems pretty common sense.
It's a good idea to do that.
Yeah. I guess only if you're interested in saving money, right?
Yeah. Yep. And sometimes it's difference between qualifying and not. Some people have scores that are, below the threshold that we can approve them, and then you get it up to that next level, and now they're approved. So,
okay.
Those are different.
What is the typical cost? What should somebody anticipate for this?
There's no cost to do any of this that we're talking about. I mean, I incur some costs, but I don't pass that on to you. So the credit report cost does come into play once you close your loan. There'll be a cost for the credit report, but it's like $90 or $100 or something total. But that's part of your closing costs. And if you never close a loan, I eat it. So for the most part, no cost.
Super cool. All right. Yeah. Okay. There's one more question. I've been waiting. I was not trying to throw you under the bus. I would like you to break out that crystal ball polish. Everybody wants to know, hey, what are rates going to do in Q4 and Q1 into next year?
They're going to go up, down, or stay the same. No, I'm just kidding. No, they're gonna probably keep going up a little bit here till the end of the year, I think, and then they're going to start to inch back down. I think. I mean, it's so volatile right now. It's hard to say, but that's what a lot of experts are saying, that starting next year with inflation starting to curb, that they should be coming down. They should follow that inflationary number and hopefully come down. In the meantime, I think there's a benefit to buying, because I just think there's a lot of people on the sidelines. As soon as those rates come down, people are going to start coming out of the woodwork, and then that increased demand. Prices, I think increased demand equals increased prices, right?
Right. Well, even right now, I mean, we've got, on our running 7-day average, we only had like 850 homes coming on market, but we still had, 12, almost 1,300 homes go pending, which means that there are more homes going off market than are coming on market. And I think that's super important for people to understand, that even now with rates that have been hedging up, and sadly 7.5, just shy of 7.5, people are saying, oh, it's going to get hate. It might, but the second that it bops back down into below 6, 6.6 and below, everybody's coming out. And our low inventory is going to get super low. It's going to be crazy. We're going to see massive escalations. We still see multiple offers, just not a lot of escalations. Although we have one home in Bellevue that had an offer review today. We've already got 12 offers on that one. So unique piece of property in and of itself, a high demand. So it's going to become absolutely insane out there. So with that being said, sage advice is, hey, keep your nose in the game. If the right home pops up, bear that burden temporarily, because after 6 months you can refinance pretty much without penalty. Is that about right?
That's right. And we have some programs right now where we're doing some very low cost, sometimes no cost refinances for people that do a loan now and refinance in 6 months or 9 months down the road when the rates get better, hopefully. And so that's another benefit. We have the low cost refi, so to lower people's rate.
All right. One last thing, and then I'm going to let you go. All right.
Okay.
Okay. Still getting questions. People are saying, hey, this 2-1 buy down, they're saying that it's like prepaying the interest. But what if I refinance in 6 months? What about all that money that I paid, which is, $13,000 to $20,000 that would have been prepaid, whether I had the seller prepay it or I prepaid it, to get my interest rate down.
Right.
What happens if I refinance to a better rate in 6 months?
Well, that money that's sitting in that bucket, basically prepaid interest, like you said, what you have not used of it will go towards principal. It's not lost money. So what I tell people is instead of buying down the rate on a permanent buy down with points, I would use that money for the 2-1 buy down because of what you just said, which is, that money is basically sitting in a little account and they're drawing from it every month to subsidize your payment, make it lower. But if you turn around and pay off that loan, whatever's left in that bucket of money towards principal, you pay down your principal. So you don't lose it. So it's nice. It's a nice way to do it.
Okay.
And way more dramatic savings temporarily.
I totally agree.
Yeah, much more of an effect. So
right on. Well, yeah. With that, do you have any parting words for the audience?
No, just have happy holidays. And if you have any questions on anything we talked about, happy to talk about it and answer any questions you might have about any of this
right
stuff.
On. And for everybody, just remember, we'll put Dan's information down below. We'll also put the free credit report link down below, along with the opt-out, landing page. Make sure that if you have questions, reach out to Dan. Subscribe and share so that if you know somebody's looking at buying or selling, or this just is really good information for them, including if they're buying a car, share this video. And in the meantime, Dan, thank you for showing up. And everybody else, you guys have a beautiful day. Take care.
Thank you. All right.